I'd like to now welcome Joel Peress from INSEAD. The title of the paper is Learning from Interest Rates, Implications for Stock Market Efficiency. The floor or the screen is yours. Thank you, Joel.
Thanks, Daniel. Hello, everyone. Thank you for attending that session, and thanks to Michal and the organizers for picking our paper for that program. So this is joint work with Matthijs Boygum and Adrian Bus, who indeed is on online in case you have questions. So the purpose of this paper is to understand the role played by interest rates in financial markets, and more specifically, their informational role. So we know that interest rates play a determinant key role for valuing assets, through discounting in particular. But they also play a role in terms of conveying information. And recently, agents in financial markets have expressed concern that artificially low interest rates have distorted asset prices, right? And they have done that, so they claim, to the point that asset prices have lost their predictive power. So rather than helping allocate capital to their most efficient use, they're just being artificially, or they lose that power. Okay, and this could have important consequences for the economy, in particular for the allocation of capital and efficiency. So we're going to try and speak to that debate, and to motivate a little bit our talk. So, which is, the paper is a theoretical paper. We have some suggestive evidence about whether these claims are substantiated or not. Okay, so we have here some evidence that's drawn from the stock market. So here we have estimated stock price informativeness using the technique of Jenny and others. So Jenny's in the session. So the by Pelifron-Sapov paper, which essentially looks at the predictive power of stock prices for future firm earnings. So this is a cross-sectional measure that we estimate year after year. And on that chart, we plot it against real interest rates. And so there's a clear upward sloping line, which is consistent with the evidence that I've mentioned early on, which is with the claims, at least, that people have, and the concerns that people have voiced about low interest rates degrading the informativeness of asset prices. So that's what this upward sloping line seems to suggest. So this is on that chart. Interest rates are, an equilibrium price. So it's an endogenous quantity that is shaped by both supply and demand factors. So we do a bit more work to try and tease out the supply and demand effects, and an instrument interest rate that there seems to be a robust relationship, upward increasing relationship, or positive correlation between price informativeness and real interest rates. So this is what we're going to speak to, this phenomenon, right? This is what we're going to try to shed light on from a theoretical perspective, right? So specifically, we're going to try to link the price informativeness with interest rates. And first, in order to determine what's the mechanism through which interest rates affects the ability of agents to learn from prices. And then we'll draw implications for stock market and real outcomes. And ultimately, we'll try to also to say a word about government policies, in particular unconventional monetary policy, as QE has become to be known. What impact does it have on informational efficiency? Okay, so what we do here in a nutshell is we develop a model with an endogenous interest rates, and from which investors are going to learn. Okay, so what are the main takeaways? In case the connection drops right here, what do I want you to leave with? Well, first, we show theoretically that investors use information conveyed by interest rates in order to learn about a stock's supply. So it's not, so interest rates do not convey information about the stock's payoff, what we would have called cash flow news, but rather it conveys information of the stock supplies, which is akin to discount rate news, because these are shocks that would affect expected returns without working their way through payoff. So it's really about discount rate news. And once investors have a better understanding of discount rate news, they can more easily disentangle from the stock price cash flow news, right? So by combining information from interest rates with an observation of the stock price, investors achieve a superior knowledge of an asset's cash flows. A key result is, which speaks to these concerns of market agents that I mentioned earlier on. The key result is that the precision conveyed by interest rates is increasing in the level of interest rates. So as a result, price informativeness and interest rates are positively correlated, as in the chart, right? And this leads to government policies or central bank policies having a direct impact on information efficiency that seems that we argue has been overlooked so far. So let me go into more detail. I'm going to first develop the framework. Then I will convey some intuition, and then I'll talk about some extensions of the model. Okay. So in order to address that question of how investors learn from interest rates, it seems natural to use the rational expectation equilibrium paradigm, and that's a standard framework. It's the workhorse for these types of questions. However, these types of frameworks are ill-equipped to study learning from interest rate for the simple reason is that the typical assumption in that family of model is that the bond is in perfectly elastic supply. In other words, the interest rate is exogenously fixed. All right, so if the interest rate is exogenous and constant, it cannot convey any information. So we have to move away from that framework. And the reason why that framework has been so popular is essentially tractability. Right, so we're going to have to deal with that with challenging tractability issue. Okay, so our framework is a standard Cara normal framework, meaning constant absolute risk aversion preferences combined with normal random variable in the spirit of Helvig 1980. So we have a static model with two periods, a continuum of investors who each receive a private signal. There's the assets of stock and the bond trade competitively in period one. What's key here, so what's key, how we depart from that standard framework is that we assume now that there is clearing in the bond market in contrast to what has been assumed so far. And as a result, the interest rate conveys information. And so investors will use that information in order to form their portfolios. We will also have consumption over both periods, period one, period two, that makes the interest rate meaningful, and investors will engage in intertemporal consumption choices between these two dates. What are the investment opportunities? So as I said, there are two assets, a stock and a bond, right? So the stock is a standard claim to a payoff that we denote pi, which is normally distributed with mean mu pi and precision tau pi. So throughout the paper, mu's refer to means, unconditional means, whereas taus refer to precisions, so inverse of variances. Okay, that stock has a price P, is in finite supply, and pays a deterministic initial dividend pi 1 in the trading run. So with this, investors own stocks, and they're going to receive a payoff from the stocks, which is completely known and deterministic. So all the action is about the unknown pi, which is going to be paid and revealed in period 2. Now, more interesting, more new is the bond market. So the bond is a claim to a deterministic payoff of 1. So 1 unit of good, if you want. And its price is basically 1 over the interest rate, which we denote RF. So the equivalent interest rate is going to be RF. What's key here is that the bond is in finite supply, as opposed to, in traditional models, perfectly in elastic supply and fixed. So here we have an endogenous interest rate. The investors, there's a continuum of rational investors with these Cara preferences. So they consume in both periods, period 1 as well as the final period. So that's novel also, that we have consumption in the early period. That obviously it's associated with having an interest rate that is endogenous. Investors observe a private signal, pi plus an error epsilon, which is ID across agents, and investors are going to learn from their signal, from the stock price that they observe, and key again, from the interest rate that will convey some information. The investors are endowed with a certain number of shares to start to kick off the economy, and that endowment is assumed to be uninformative. As is standard in these models, we're going to assume there's some noise trading or liquidity traders that allows to blur the price signals. And since we have two price signals, the bond price as well as the stock price, we need two sources of noise, else it will all the uncertainty would unravel in equilibrium. So we denote theta as these random supplies. Theta x is a random residual supply of the stock, and symmetrically theta y is the random residual supply of the bond. And they're normally distributed with means denoted by mu's and precision by taus. Okay, so here's an overview of the model. In period 1, we have portfolio choices and consumption choices. Investors observe their signals, the stock prices, interest rates, and they set up their portfolio and consume. Importantly, stock and bond market clear. And then in period 2, investors consume the proceeds from their portfolios. So this is somewhat a complicated problem to solve. So let me start with a version of the problem which is tractable, which delivers a closed form solution. And then later on, I'll tell you how we deal with the more general model. So simply to provide intuition for this presentation, I'm going to shut down consumption in period 1. Okay, there will be no consumption in period 1. There will only be consumption in period 2. Still, I'll make the interest rates endogenous, and I'll allow investors to learn from the interest rates. Okay, so we can keep the gist of our economy and the learning from the interest rate in that setup. Okay, so here we can derive a closed form solution, despite the fact that prices are not linear in the random variable. And the way we can do that is that we extract information from the market clearing conditions, which are linear. Okay. So what is the key? Let me show you the key equation in this economy. The equation here on the slide is essentially an aggregate resource constraint. Right? It says it has on the left-hand side the total resources available in aggregate to our investors. So investors in aggregate hold a supply theta x of the stock. Each share is worth P and pays out a deterministic dividend pi 1. So on the left, that's the aggregate wealth of our investors. These investors, because we assume they cannot consume in period 1, save their entire wealth. And they save it either through stocks, theta xp, or through bonds, theta y times the price of the bond, which is 1 over RF. Okay, so on the right-hand side, we've got the total savings of investors in aggregate, which is split between stocks and bond holdings. Okay, this is the key equation. This is the equation that essentially shows how the interest rate conveys information. I can rewrite it. So this is an equation that connects the supplies of the stock and the bond across the two markets. Okay, the random unobserved noisy supplies, theta x and theta y. I can rewrite this equation in a simpler way in red here, which essentially shows how you can think of this as being a signal about theta x with noise given by theta y over pi 1 RF. That is, with noise given by the random supply of the bond, theta y, scaled by the model parameters. Okay, so the bond market provides a signal about the random stock supply, theta x, and what is key here is that the noise in this signal, this theta y term, is being scaled by the interest rate RF. A higher RF, higher interest rate, implies a lower sensitivity of the noise to the bond supply. So essentially scales down, dampens the noise in this equation. So this is the equation that allows us to extract more accurate information about cash flows from the price. So once investors look at the interest rate, they back out some information about the stock supply, and then they can use that to get more accurate information from the stock price about the stock terminal payoff pi. Okay, so based on the interest rate, we can form posterior distributions of the stock random supply theta x. It's given by, so we have a tau term that is basically the posterior precision, and a term that is a posterior mean. The key point here is that the posterior precision of the random stock supply is increasing in the interest rate. It's again the same intuition that the noise in the bond equation is being dampened when the interest rate is higher. This model, interestingly, nests the standard Helvin model. We can shut down learning from the interest rate by setting the precision of the bond supply to 0, tau theta y. Essentially, the structure of the economy here is very similar to a standard Helvin model, in which we replace the prior mean and precision of that stock supply with the posteriors conditional on observing the interest rate. Okay. This is a graphical depiction of price informativeness. The key here is that the precision of the stock price signal is increasing in the interest rate. Right? In the standard heading model, it would just be flat, horizontal. That's a dash. That's the dotted green line. In our economy, as the interest rate grows, which is on the x-axis, the precision of the stock price signal goes up. And the right panel shows that for some set of parameters, how much you learn from the interest rate can be quite sizable. Okay. So again, the key takeaway here is that the informativeness of the stock price is increasing in the interest rate. Now, that was a little toy model in which we had shut down consumption in period 1 in order to convey some intuition. Let me go back to the, like in quote, full model with intertemporal consumption. So let me switch back on consumption in the first period. Okay, so now the model cannot be solved analytically. So we resort to a numerical algorithm to do that, right? But essentially, we find that the mechanism that we have, that I've shown you in this simplified model, by and large, obtain in this more sophisticated model, right? In particular, the key equation that I showed you earlier on, which I've plotted here with the familiar terms in red. Now there's a new term because the aggregate resources or the aggregate wealth of agents can now not only be saved, it can also be consumed in period 1. So now there's another term in that bond market clearing equation that complicates things. But the point here is that we can show numerically that that price informativeness rises in the level of interest rates. So on the left panel here is the interest rate as a function of the mean bond supply. It's increasing. That makes a lot of sense. If there's a bigger supply of bonds, the bond price is lower and the interest rate is higher. And on the right panel, we have price informativeness as a function of the mean bond supply, and it's increasing. So the point of putting on the x-axis the mean bond supply rather than the interest rate is that in this economy, the interest rate is endogenous and random. Right? So here we can plot price informative as a function of a deterministic parameter. Okay, so here, as in the toy model, price informativeness is increasing in the mean bond supply and therefore in the interest rate on average. As the interest rate goes up, agents are going to substitute consumption. I'm going to save more and consume less in the early period. Okay, we can characterize properties of asset prices in this economy. In particular, we can show that as interest rate goes up, price informativeness goes up. We know that, and this implies that risk goes down, expected returns go down, the price of risk goes down. Okay, so all of these are consequences of being better informed thanks to the interest rate. And so to the extent that interest rates are cyclical, this implies that the level and price of risk, the volatility of returns, they are all counter-cyclical, which is consistent broadly with the data. We have a bunch of extensions, and let me say a quick word on these. We add another stock to the model in order to speak to the correlation between stock returns. And the idea here is that when there are two stocks, this key equation that I showed you that connects the stock supply to the bond supply now connects the supplies of the two stocks together. So their weighted sum is going to be related linearly with the bond supply. So that now the interest rate is going to give you some information about some kind of weighted average of the two stock supplies. So that if you think that one stock has a large supply, then because the sum is constrained by this market clearing equation or resource constraint, then the other stock will have to have a lower supply. So this, in our mechanism, learning from the interest rate is going to induce an excess correlation between the returns of different stocks. And that excess correlation is tied to learning from the interest rate, which is reduced when the interest rate is lower. So again, this leads to the extent that interest rates are cyclical, to a bigger co-movement between stock returns in times of high interest rates. We put into the model real investment, so it's not just a nominal model or model with exchange in an exchange economy. We can put in a real sector, and we can naturally show that improved informational efficiency leads to improved real efficiency or allocative efficiency. So this speaks to to efficiency of the economy. We also embed into the model a government to speak to monetary policy, so more specifically to unconventional monetary policy like QE. And what we get out from that extension is that on the one hand we put in money into the economy. There's also money. And with money comes a price, essentially the rate of inflation. And we show that in the same way that investors learn from the real interest rate in our baseline model, investors are going to learn from the inflation rate in this extended model with money. So now we got two price signals, the real interest rate as well as the inflation rate, which are going to convey information. By and large, the mechanisms are the same, but but it's interesting to know that inflation also is going to be conveying some information about the supplies of the assets in the economy, which are going to be useful for learning about asset payoffs. We also, in this economy, we can also speak to the role of policy transparency. In particular, we can show that more transparent government policies allow to enhance price informativeness without having to necessarily increase the interest rate. So in a sense, if you're more transparent in the sense of having a higher precision of bond supply, then the implementation of monetary policy is going to be more efficient. And policymakers can enhance price informativeness without having to go through the expense of actually increasing interest rates. Okay, let me conclude here on this. So we developed a rational expectation model with an endogenous interest rate. We show that interest rates reveal information about the stock supply, which we call discount rate information, which in turn allows investors to extract more information about the stock payoff from stock prices. And a key result is that the informativeness of prices is increasing in the rate of interest, and therefore in the mean bond supply. This prediction is by and large supported in the data, in line with what with the concerns voiced by market participants. And then we show how through that mechanism of learning from the interest rate, various economic variables are affected. Some financials like return volatility, correlation, as well as real variables such as allocative efficiency. That's it. Thanks a lot.
Okay, great. Thank you, Joel. Yeah. So we have now Marcin from Imperial College in London being the discussant. I think Marcin is getting ready to share slides. Thank you very much. So you have 15 minutes for the discussion. Thank you.
Okay, thank you, Daniel. So I wanted to thank the organizers, especially Michał, for putting together this wonderful conference. I also realized that these days you can attend two conferences on two different continents in such a short time period. So going from the cavalcade to Stockholm in such a short time period is quite impressive. And last but not least, discussing two papers written by or co-written by the same author has never happened to me before as well. So it's quite an interesting coincidence. All right, so I want to say that I really like this paper. In some sense, I thought that I was quite happy that I was asked to discuss this paper because it kind of brought me into this paper from two different strands of literature that I've actually tried to work on myself. So one is the literature on information economics, but the other one is the literature on monetary policy and especially the role of some kind of unconventional policy that Joel was talking about. So Joel did a great job, not surprisingly, presenting the paper. So I'm not going to spend too much repeating what he said, but let me just briefly say what the story here is. So I think this question that they are after here, kind of, as I said, comes from two interesting point of views. Of course, from the pure macroeconomic perspective, we definitely noticed that the last decade was very much centered on the monetary policy and government actions in this particular role. So there is this whole discussion about whether the monetary policy is actually enhancing the economic output or is there maybe some kind of unintended negative consequence. So a lot of what we've been talking about on this particular front was related to the questions on economic growth, inflation, employment. So macroeconomists have been extremely vocal in that particular place. But at the same time, what I think we know much less about the microeconomic kind of foundations of some of these effects. And this is where I think this paper can really help. I think we definitely know something, but there is still more to be learned. So this is one motivation which I think is very nice. The second motivation is coming from the information economics. Of course, we are familiar with this model where we try to put some kind of learning on the agent side. And as Joel has said, it's true that pretty much any paper that we think about actually makes this critical assumption that interest rates are exogenously fixed. And yes, it is probably true that tractability is one of the issues, but I think it's probably also fair to say that one of the reasons why actually we haven't paid attention to that is that interest in many of this paper was on other quantities. So this is what this paper now does. It tries to kind of bridge these two questions together in a very nice theoretical framework to endogenize some kind of monetary policy, or maybe more so learning about interest rates into this noisy rational expectations kind of equilibrium, and try to inform our debate about some economically important objects such as price efficiency and also potentially asset prices. And I think within this model, the model also gives us some kind of ability to talk a little bit about the role of monetary policy in terms of interest rates, maybe some kind of quantitative easing kind of schemes, and maybe inflation kind of targeting, as Joel was talking about towards the end of his presentation. So just to kind of give the main message in terms of intuition and main results, I think if we think about the standard models of informational economics, we usually have some kind of risky asset payoff. And this price of these assets usually depends on this payoff pi, as Joel indicated. And there is always this notion of the random supply that here is denoted by this quantity theta x. So this is how most of the models are actually set up. In this kind of framework, there's of course an equilibrium in which markets have to clear. And in that clearing condition, we usually assume that there are two assets, one risky, one risk-free. And then basically the risk-free asset has kind of elastic supply and also exogenous interest rate by implication. So what's different here? Well, the difference now is that we are going to take the residual income that we have from the endowment that we have W0. And we are going to basically assume that that supply of the residual asset, which is the bond here, the theta y, actually is a stochastic object. So this is an object over which we can actually also learn. And Joel mentioned that, and this is to the right of this equation here, that what's critical is that we can derive this kind of nice, basically formula that links the two markets together. There is a market for risky assets, the stocks, the X, and there is a market for the risk-free asset, Y, which is the bond. And what's interesting is that the implication about the prices of this stock or the X asset are kind of driven partly by what's happening in terms of the supply of the other asset Y, as well as the interest rate that this asset actually generates. So this is kind of neat because by putting this equation together, we are kind of getting a nice spillover effect from one market to the other. And this is in essence what this paper is trying to exploit. It's trying to learn how much we can push this market clearing condition in the way how we can learn about P and then about some potentially interesting objects from the economics perspective. And there are a couple of results, so I'm not going to spend too much of time on that because Joel did a good job and maybe also in the interest of time. But effectively what we learn is, as the main kind of headline result, is that the supply and the level of interest rates, supply of bonds and the level of interest rates in this economy actually do affect price efficiency, both the informational and the allocative pricing efficiency. So there is basically a message to be learned here that we should actually care about what this monetary policy in some sense does, because there is this inverse relationship between the the positive relationship between the level of interest rates and the level of price informativeness. Okay, so there is an additional twist that Joel mentioned again, that it is not only about the so-called FPE or the forecasting price efficiency, but it's also about what firms do in terms of their real allocations. So clearly, this has more kind of real implications than just financial implications only. So I'm not going to spend too much time going into details of this model. And I must say that this is not a trivial model. So this is not to say that the model is easy and we should not think much about it. But instead, I will try to kind of give slightly different perspectives on what the authors are doing here. But needless to say, this is an extremely clever paper. So lots of really interesting results. I learned a lot about how to solve this model in this kind of endogenous interest rate environment. Okay, so let me start with the first comment, which is kind of a comment on what it is that we are learning from this exercise about the role of monetary policy for price informativeness. So clearly in this whole discussion of interest rates, etc., we care about the supply and the demand forces. So here the kind of supply of the bonds is key, because this is kind of what gives us a traction in terms of how we learn about the risky asset X. But what's also important, that any kind of demand that is basically happening in the market for bonds is kind of happening through the wealth shocks to the individuals. So effectively, if we are changing the W0, we are changing the demand for bonds, and subsequently that kind of spills over to the learning kind of process. So what I want to highlight is that within this model, we could also have similar type of predictions. And again, it's maybe not all of them, but I think kind of important, which are related to changing the risk aversion parameters. Rather than thinking about the wealth, we could think about so-called flight to quality effects. And especially when we want to talk about the recent decade, the unconventional monetary policy, clearly a lot what we have observed in terms of the bond prices, the treasury prices were due to some kind of changes in risk aversion. So I think it would be interesting to take this model and actually play with some kind of risk aversion parameter, which is of course part of this model, and try to see to what extent some of the results in this model are observationally equivalent to just the comparative statics on the risk aversion, vis-a-vis some kind of other basically mechanism that the paper proposes, which has something to do with the changing the stochastic supply of the bond. So I think that would kind of shed light on where it is that we should think about the shocks as playing an important role in this particular markets. And of course, a separate and interesting question would be then whether monetary authority can control actually the value of this asset supply in a way how it is going to internalize basically this flight to quality forces. So second comment is a little bit about empirics, but even though acknowledging that this is not an empirical paper, of course, the picture that Joel presented is very interesting, but I just have a few comments on that. So the first one is that in this picture, when we look at 40 years worth of data, clearly we need to realize that the price efficiency is also a function of the composition of the economy. The economy in the 70s was a very different economy than it is right now. So just kind of taking these aggregates and trying to draw some kind of implications about the role of interest rates, especially since most of the observations on the low interest rate kind of part were coming from the 70s, and a lot of observations were actually towards the end were coming in the 90s and early 2000s. It may be a little bit hard to actually draw some conclusive implications. And then I think a little bit sadly in the empirical part, we kind of don't see much of this unconventional policy playing a role. I think it would help if the authors maybe shrank the horizon, because right now we work with 5-year horizons in terms of predictions, to kind of get a little bit more data points on how it is that these results actually look like towards the end of the last decade, basically, or this decade, if we wish. Okay. Next comment briefly, I think in terms of like a big picture policy, I think we also need to understand that in the way how we want to think about the monetary transmission, we need to think about the changes in the monetary decision, but in terms of like asset supply on the effect on interest rates. But of course, there is also a transmission mechanism by which any kind of action that is taken by the policy maker is going to actually transfer to the real economy. So within the model, of course, it is hard to understand how this transmission mechanism works. But I think many people, critics would argue that basically in the current situation where the failure is not so much in terms of monetary policy being actually applied in the wrong way, but more so actually there is no transmission happening from the financial sector to the real sector. And I think it is important to kind of qualify this before we start jumping on the so-called negative effects of monetary policy, say on price informativeness, because in the world in which this transmission mechanism works, it's not obvious at all that actually information would not be carried over from one market to another. So finally, in terms of kind of positioning the paper, I mean, it's very nice to talk about this whole idea of what does the monetary policy do here. But I think there is an important caveat kind of to put in place, which is in the model right now, the monetary policy in some sense is exogenous, or at least it is exogenous from the perspective of how the monetary authority internalizes the price informativeness. So if we want to talk about kind of a notion of what's the role of, say, monetary objects on price informativeness, we would need to kind of more specifically specify the objective function of the monetary authority, and then try to see how that objective function fits into how basically the policy shapes the price informativeness. Right now, I think this aspect of the analysis is missing, so it's a little bit hard to actually make an interpretation as to whether this actually is a positive or a negative effect in terms of what it is that actually the government is trying to maximize, or what the some kind of Fed is trying to maximize here. So within the model, then, it would be very interesting to actually think of these counterfactuals and try to understand how much welfare do you generate under one versus the other kind of economy. And I think that would be a nice extension of the model that you have right now. For now, at least, I would tone down a little bit this story of unconventional policy, the way how it is kind of pushed. But overall, I think it's an excellent paper, a lot to learn from. I think this is a must read for any kind of PhD class. I strongly recommend to everyone to read. I think it has the potential to inform a discussion on the role of the unconventional monetary policy. But as I repeat from yesterday's discussing another Adrian's paper, I think we really need to be a little bit careful in how much we can actually draw from this exercise in terms of what is really that the government is doing in terms of its monetary policy. But overall, really, really excellent paper. Thank you so much.
Okay, Marcin, thank you very much for the excellent discussion. Before we go to the floor, shall I give Joel and maybe Adrian as well, since he's here, a couple of minutes to respond, maybe in 1 or 2 minutes, and then we have Lian Yang from the floor asking a question.
Yeah, so many thanks, Marcin. Lots of great comments. I mean, I don't have any specific answers here on the spot. Clearly, we can, I think looking at flight to quality, comparative statistics on risk aversion, that's a great suggestion. The data points are well taken. You know, there's limited data, you know, and especially when you want to speaking to QE, which is a more recent phenomenon. So maybe we have to go micro or leave it to true empiricists, right? So maybe just lay out some theoretical predictions and let them do the serious work. Endogenizing monetary policy, that also would be very interesting. So indeed, in a sense, it's a first step towards that. We could have an objective function, a Taylor rule, or something like that guides monetary policy, and see how it fits. That would be very interesting. You know, again, thanks a lot. We'll process, and then we'll manage.
Again, congratulations.
Thanks.